How to calculate the intrinsic value of a stock. Considering it makes X amount of cash each year. Once we figure out how much we'd be willing to pay for the business, we can then compare that intrinsic value to the current market capitalization of the business. So if your company was selling for a market cap of $105 billion, can that business deliver enough cash to you soon enough to make it a sensible investment? The long way of saying it, as Warren Buffett does, is the discounted present value of all future cash flows. Then we'll receive 10 years of juicy profit from the business's operations, and then we'll get a big one-time check when we sell this thing in 10 years' time. So first step is to find the amount of cash this money printing machine makes for its owner every year. That is the free cash flow. So the business makes money and spends money, and the free cash flow is what the business owners could potentially keep each year. It is the cash flow from operations, or sometimes just the operating cash flow minus the capital expenditure, alternatively known as the purchase of property, plant and equipment. We have the business's free cash flow. Then the next step is to figure out how well they're going to be able to grow their cash flow each year for the next 10 years. Now this growth rate is down to you and your research, and it will be different for every single company. Number 1. Look at the prior 10 years of free cash flow growth and equity growth. And then 3. Actually understand the future growth drivers for your business and how they will likely impact the cash flows. And what will that mean for Tesla's free cash flow considering their current margins? So let's now grow the free cash flow out by 10% per year for the next 10 years. It's pretty easy. Just multiply the previous year's free cash flow by 1.1%, and then after that, now we're going to sell this thing. Well, let's look at what multiple of free cash flow the business has been selling for over the past 5 years. If we take the average, and let's say we could probably sell the business for that free cash flow multiple in, say, 10 years' time. So now what we need to do is multiply the 10th year of free cash flow by our free cash flow multiple to get our terminal value. But remember, this process is finding the sum of all the discounted future cash flows. Well, remember Buffett said, can the business deliver the cash to you soon enough to justify buying the business at its current price? All we have to do is discount the future cash flows by 15% per year. Even though the company is growing its cash flows at 10%, the present value of that future cash flow is actually getting lower and lower year by year because of that opportunity cost. It's very interesting, and that's why Buffett in that clip said the further out in time you go, the less consequential it is to your intrinsic value. But anyway, so we've discounted the 10 years of future cash flows, 15% per year. So what we've just done is we've calculated what we pay today for the annual future cash flows we'll get from owning the business, and we've figured out what the big one-time check is worth to us today from selling the business in 10 years' time. Now simply add all the discounted future cash flows together, and that's the intrinsic value of the business today. If it grows its cash flows at 10% per year, you can sell the business in 10 years at 25.5 times free cash flow, and you want to achieve 15% returns per year, $595.97 billion in this instance. There you go, we did it. So give it a try on your favorite company and let me know how you go. Chances are, honestly, in this environment, most businesses will be trading above intrinsic value, but you never know. So anyway, guys, that will do us for today.